Hey there, so today I'm going to create a brand new investing portfolio starting with just $1,000 to see if I can actually get it up to a level that will allow me to retire. The twist is that in this retirement portfolio, I'm only going to invest in 3 ETFs. 3. That's it. It's going to be a 3-fund portfolio. Of course, I'm going to continue to invest more over time and build up the positions, but the idea is to create a 3-fund portfolio that is so absolutely simple that all I have to do is set it in motion and then wait for 30 plus years until I actually need to use it. So over the next couple of minutes, I'm going to tell you how much I need to retire, talk about why I'm creating a portfolio with just 3 ETFs in it, and show you the 3 ETFs that I've chosen, talk about why they make a good portfolio, discuss the percentage allocation of each ETF in the portfolio, and then actually make the investments right here today. In the coming months and years, I'll bring you periodic updates to show you how this strategy is performing, and I'm going to compare it to some of the other experimental portfolios that I've got on the go on this channel. For instance, my penny stock investing portfolio and my crypto portfolio, among some other things that I have in the works. First of all, how much do I actually need to retire? Well, let's say I retire at the age of 65 and plan to live off around $50,000 per year, which I think is reasonable. It's not going to be a luxurious retirement, but you could definitely be comfortable on that. Now, if we assume that I live to the age of 90, that means I'm going to have to cover 25 years of living expenses. 90 is definitely on the older side. It's longer than the average life expectancy for males here in Canada, but I think I want to err on the side of caution with this calculation. So when I crunch those numbers into a retirement calculator, it says that I need to have around $1.4 million at the age of 65. So since I'm starting with just $1,000, I better get cracking then. Now, of course, I'm going to add to this portfolio over time, a couple $100 every month, and as I get older and have more disposable income that I can allocate to this, I'll put larger and larger chunks into it. So it will be definitely a snowball effect. So let's talk about why I'm going to create this retirement portfolio by investing in just 3 ETFs to make a 3-fund portfolio. Basically, what it all boils down to is that studies show that everyday normal people have essentially no chance of actually beating the S&P 500 index. Over 90% of investors, including institutional investors and smart money, underperform the S&P 500 over time. 90%. Now, some people might look at that statistic and feel overwhelmed and resign themselves to a life of bag holding. The reality is though, once you understand how difficult it actually is to consistently outperform the market index, it's liberating. Instead of wasting all that time, energy, and effort trying to pick and choose winners, doing all this due diligence, all you have to do is buy the index. If you can't beat them, then join them. And that way, you're guaranteed to actually outperform 90+% of the people that try to do the opposite, that try to pick and choose the winners. Now, the idea of the 3-fund portfolio is that with 3 simple ETFs, you can create an incredibly diversified portfolio that tracks companies large and small all around the world. There's lots of different ways that you can put together a 3-fund portfolio, allocating different percentages of the total portfolio to different markets or to large cap, small cap, medium cap, to bonds and fixed income, and so on and so forth. And the asset allocation that you choose in your portfolio should correspond to the level of risk that you're willing to take. Simply put, conservative investors will put a higher percentage of their portfolio into bonds and fixed income to avoid some of that market volatility, whereas growth investors or people that are willing to assume some more risk might go all in on equity. And actually, I'm going to do just that. So my 3-fund retirement portfolio is going to be made up exclusively of equity investment. I'm going to focus mainly on North America, but I am also going to allocate a percentage of my portfolio to global markets. Now, before I break down the 3 ETFs that I'm going to invest in and actually make those investments, let me tell you why I'm going all in on equity and putting 0% of my portfolio towards bonds and fixed income, even though this is technically a retirement portfolio. There's 2 main reasons. First of all, I'm still relatively young. I'm 30 years old, so that means I have 30 to 35 years where I'm not even planning to touch this at all. And so that means I'm not concerned about the market cycle in the short or even the medium term. And when you have such a long time horizon, you can afford to take more risks. Maybe later on down the road, as I get older and I'm getting closer to retirement, I might cycle through some of my investments and change the percentage of allocation. Number 2, this is not going to be the only source of income for me in my retirement. First of all, since I live in Canada, I'm going to have an old age pension once I reach the eligible age. And secondly, since I work for the Federal Public Service, there's actually a very generous pension plan. And the government pension is actually invested through a relatively conservative approach. So I figure I'm all covered on that front, and that means that I'm able to take a little bit more risk on with this portfolio here. All right, so now it's time to talk about the 3 ETFs that I'm actually going to invest in. And as I discuss the ETF, I'm going to talk about what percentage of the portfolio I'm going to allocate towards it, and then I'm actually going to purchase the shares right now as we go through this. So first up is going to be ticker symbol XUU, which is the iShares Core S&P US Total Market Index ETF. Now, simply put, this ETF tracks the entire US stock market. So for current price of $42.17, you get to invest in 3,698 different companies. The dividend yield of this ETF is currently at around 1% per year, and the management fee or management expense ratio is 0.07% per year, so it's very, very low. Now, if we scroll down here to look at the holdings, you can see that it's heavily weighted towards the S&P 500 at almost 50% of the portfolio, but then it's also got exposure to the total US market as well as specifically mid-cap and small-cap companies. So for $42 Canadian, you get to invest in practically 4,000 different companies spanning the total spectrum of the US stock market. Now, of course, there's other options that I could have chosen here. For example, ticker symbol VUN is Vanguard's version of the same fund, but that one has slightly higher management fees, and also the share price is slightly higher, which just makes it a little bit more difficult to keep the portfolio allocation percentages the way that I want it. Also, I could have just gone with an S&P 500 tracking index fund like VFV, for example, because if you look at the results over time of the S&P 500 and compare that to the total US stock market, it's actually very, very similar. However, I still opted to go for the total US market fund here because it has much higher diversification with thousands of companies as opposed to hundreds, and also it gives a little bit of exposure to small cap and mid cap. So I'm actually going to allocate 50% of my total portfolio towards this ETF, and I'm going to try to maintain that percentage as closely as I can over time, even as I continue to add to the position. So this really is going to be the core of my 3-fund portfolio, and it's going to underpin the entire thing. It's pretty much one of the safest long-term bets out there that you can find, and you can be pretty much sure that if this index is completely crashing, then the global economy is totally screwed anyways, so what does it matter if you lost a few $1,000s? The next ETF that I'm going to invest in today is ticker symbol XIC, which is the iShares Core S&P TSX Capped Composite Index ETF. Now, this ETF is very similar to the first one, except that it tracks the Canadian total market instead of the US total market. So for $33.74 Canadian, you get to invest in 233 of the largest companies in Canada. The dividend yield of this ETF is currently sitting at around 2.5% per year, and the management fees are 0.05 or 0.06% per year, so also very low, even lower than XUU. This ETF covers large, mid, and small cap companies in Canada, but it's much more heavily weighted towards the largest companies. So for instance, if we look at the holdings here, you can see that the top 10 include Shopify, Royal Bank, TD, Brookfield, Enbridge, CNR, etc., etc., etc. Now here there's also lots of other options that I could have chosen. Vanguard, for instance, has ticker symbol VCN, which tracks the Canadian market and is very similar, although has a little bit less diversification, and also the share price is higher. So again, I chose this one to try and keep my portfolio allocations as close to my target as I can. Now, I'm not investing in the Canadian market here just because I'm a Canadian, although that probably is a part of it, but in reality, this market index is not going to perform exactly on par with the S&P 500 because the Canadian markets are much more heavily weighted towards financials, energy, and also resource stocks. So I want to make sure that I have exposure to the broader North American market, and this is going to round out my portfolio nicely. So I'm going to add 30% of my portfolio allocation to this stock, which is going to be $300 currently, and of course I'll continue to build up the percentage of the portfolios over time. And the final ETF in my 3-fund portfolio is going to be ticker symbol VIU, which is the Developed All Cap X North America Index ETF. So what does this fund do? Well, it tracks the global developed markets, not emerging markets, but developed markets, excluding North America, so Canada and the US. The management fee of this ETF is 0.22% per year, so it's a little bit more expensive. And the annual dividend yield is currently 2.26%. And for the price of just under $32 per share, you get access to 3,901 stocks worldwide. Now, if we look at the asset allocation, first of all, you can see that most of the companies in this ETF are large cap, but it's got a little bit of exposure to small cap and medium cap as well. And if we look at the regions and the specific countries, you can see that it's basically all Europe and Asia. But in Asia, it's only got developed markets. So we got Japan actually as the #1 stock market that has 24% of the total fund. And then we've got a lot of European countries like the UK, France, Switzerland, etc. We also got South Korea and Hong Kong in there, but you'll notice that China is missing, that India is missing, and all of the other emerging markets are missing. And that's actually a conscious decision on my part because there's lots of other options out there. You can invest in emerging markets only, or you can invest in a blend of emerging and developed markets globally. But I chose this ETF because my current stance is not to invest in Chinese companies for principled or geopolitical reasons, but also for a more practical reason as well. The Chinese government regularly interferes with the market, and you never really know what's going to happen. We've seen recently with Alibaba some of the stuff that goes on behind the scenes, and I don't really want to be a part of that because you never really know when the rug might be pulled out from under you. And yes, I may miss out on some growth opportunities here because there's a lot of that in China, but honestly, I don't really care. This allows me to sleep at night. So I'm going to allocate 20% of my portfolio to ticker symbol VIU, which is around $200. Now, even with the share prices that I have here, I'm not able to maintain the perfect portfolio allocation of 50, 30, 20 that I was aiming for, but it's close enough for now. So let me give you an overview of the entire portfolio. So here it is. I have a 3-fund portfolio, 3 simple investments that provide me with exposure to over 7,800 companies worldwide. We're heavily weighted towards North America and specifically the US, but we do have 20% exposure to developed European and Asian markets as well. And honestly, I think this strategy is going to perform pretty well over time. This is the type of broad-based and diversified portfolio that really should form the core of most investors' total portfolios. So what now? And what if there's a market crash? Well, like I said at the beginning of the video, I'm going to just continually add to this portfolio and build it up over time. And with the position that I'm in here, with the type of time horizon that I'm looking for, a market crash would actually be great for me because I'll just continue to dollar cost average into these positions over time. And if the markets are super, super low, that just means that I'll be able to buy more shares for my money. I'll bring you periodic updates as we go along on how the portfolio is doing. And I'll also compare this investing strategy to the penny stock investing experiment that I have on the go and the crypto investing experiment that I have on a go. Because I think it's going to be really interesting actually to see what the ROI is of these different approaches. Anyways, thanks so much for watching. If you enjoyed the video and found it helpful, please don't forget to drop a like down below and subscribe to the channel. I'll be bringing you lots more content on investing and personal finance as well as starting a business. So I'll see you in the next video.